in the past. My name's Ashley. I've been a loan officer since 2007. I bought my first home in 2009 and had a terrible experience. And that's kind of like what drove me to really get into the mortgage industry. I have a degree in finance and I love numbers. So if you ever see me on any social media platforms, I always usually it'll say mortgage math with Ash. I'm a numbers person, and I always will say that I just love it because numbers don't lie. So let me just pull up one thing. So if you were in the waiting room, one thing did pop up. There was two little notes on there. So when you purchase a home, one thing that a lot of people don't realize is that once your credit report is pulled, as far as a full credit report, it's actually that information can be sold. It should have stopped a lot in March, but it's still, you could get hundreds of phone calls, texts, and that information that you've applied for a home loan, who you've applied for as well, is all not public record, but it can be purchased. And so people start in imitating other people, doing kind of some crazy stuff. So we always recommend this federal opt-out link. It sounds like it would be not real, but it is. It's done by the credit bureaus. You can kind of go through, scan the code with your phone, scroll to the bottom. You can opt out electronically, and it gives you, I think it's like a 3-year opt-out now, or you can send in a mailer forever. And then you'll see a QR code pop up a couple of times. If you have any questions, you want to schedule a consult, you want to do an application to get started, that will be available. It's always on my website as well, ashleywillardmortgage.com, but it'll pop up a few times and I can put it in the chat as well. So if you have questions as they pop up, please bring them up. If they're relevant to what I'm talking about, I'll kind of go into them. If it's something super specific to you, again, I'm happy to go over all of the things as well. So I've helped over 1,000 homeowners purchase and refinance homes since 2007. It's more than that, but when I was at a big bank, I wasn't really keeping track. And like I was saying, mortgages are just math, but purchasing a home is really one of the biggest financial decisions you're ever going to make. And I really believe that it's part of an overall financial plan that you can have. So where I like to kind of start people, and I just feel like, we had the HGTV would tell you, hey, what is your dream house going to be? And then we've got these influencers online about, I'm buying some bajillion-dollar house because of posting Amazon reviews or whatever. I just feel like we've gotten so far away from what your first house or even your second house really should be. So I always like to tell people, and you can put it in the chat as well, but really imagine like what your ideal current house would be. Now, if you say, Ashley, I just inherited $600,000 from my grandma and I want to go and buy a house that overlooks the lake and the city, I'd be like, that's great. Let's go do that. But realistically speaking, most people are going to be starting with 3%, 5%, 10% down payment, getting into a home that kind of meets their current and future anticipated needs. Maybe it's the oldest house in the best neighborhood. Maybe it's a duplex. There's just whatever it makes sense for you financially, and will bring you joy. So imagine what your current ideal house is. And if you have a house in mind, I love it when you guys send me links, either in the chat or if you send them to me on anywhere you see me, Facebook, Instagram, email, and just say, hey, what are your thoughts on this house? What does the payment look like on this house? What are my options on this house? Those are one of my favorite things to do. I love a good Redfin link. Now I feel like you've got to use Redfin and Zillow to really see what's going on. The biggest shift that we've seen in the last 10 years is that the median home buyer age for first-time home buyers is nearing 40 years old. So we used to be able to do those kind of like those home hacks where maybe you buy that 3-bedroom, 2-bath house in a decent neighborhood, but it doesn't have like the best elementary school, best junior high schools, etc. Or you bought the duplex. You bought the duplex with both units. You put 3.5% down. You lived in it for 1 or 2 years. You rented it out and then you bought a bigger house, or you sold it and then you bought a bigger house. You had rental income, or you earned the money, that equity from the increase in value. That doesn't really apply if you are closer into the median age of a first-time home buyer right now, where that's going to be closer to 40. So the reason for that is because as you age, as you get 35, 45, 55, it's not just you anymore. You're looking at, the schools for your kids obviously matter a lot more now. If your kid's in a high school and they're in sports or something, you really don't want to uproot them as much as it is easier to do when they're in elementary school. And really that multi-generational living, are you bringing in aging family members? And what does that look like? So, and then logistics, things like parking. If you've got bringing in family members and you've got teenagers, all of a sudden you can't maybe do that smaller home because you really need that 4-bedroom house with 4 parking spaces, 4-car garage, 3-car garage, whatever it may be. So it's just a different conversation. We used to just be able to say, let's get you into a starter home. And now a starter home may be a little bit more elevated depending on your needs. So the biggest things, I say these things because I did these things. In 2009, I bought my first condo with my boyfriend at the time, who's now my husband. We actually weren't sure what we wanted to do. We were living in El Dorado Hills, California. And then we weren't sure because we had both kind of our jobs, our companies were more in like Natomas, West Sac. So we actually rented in Natomas for a year, realized we wanted to move back to Folsom. And we bought one of the oldest homes with 100-foot redwood trees. And I wish I need to find pictures, purple walls, orange walls. I mean, there was extension cords going through the backyard. It was horrendous, but it was one of my favorite houses. Actually, a little bit sad we sold it. And then we had no kids at the time. We built our dream home when we had a 9-month-old baby, and we had views of the city, views of the lake. We thought, this is it, this is the dream. And then we had a second kid, and then we had a third kid, and we all of a sudden realized we had isolated ourselves on top of this hill, and we really needed more space. We needed the flexibility, and just based on the price point, it was going to be insane. So we ended up buying some rental properties in South Carolina with the equity, with the value we had built in our house. And then we actually just built a home out of state as well. That's my home. I just took that picture the other day. So that stepping stone, that 1,000 square foot condo, I never imagined that it would get us to where we are, but it can. And I see people say all the time, I'm not patient, I don't want to wait. And that's part of the thing, is being patient. So I've got little kiddos running in here. 1 second. All right. That's life right there. So the biggest things right now that we're seeing is credit scores. A lot of people are scared to even try to apply because of tariffs and because of everything past COVID times. You know, gas got more expensive, groceries got more expensive, people have more credit card debt, you have IRS repayment plans, etc. Credit scores are at some of their lowest that we've seen. And based on what people expect, they think I have a 587 credit score, I'm never going to be able to do anything because that's what someone told me. And if you had talked to me 10 years ago, even 6 years ago, and you said, Ashley, what are my options with a 587 credit score? I'd be like, oof, not a lot. And now there are more options. Now you're not guaranteed a loan with these credit scores, but based on an automatic underwriting approval engine, there are more chances to buy a home. FHA and BA, the FHA is the Federal Housing Administration. It's not just for first-time buyers, even though a lot of people think that. That is going to allow you to potentially go as low as 580. And if you have compensating factors, if you have a larger down payment, if you can show proof that you've made your monthly rent payment on time for 12 months or more, based on like Zelle payments, bill pay, if you've had a private, sorry, not a private, if you have a property manager, not a private landlord, that's much easier because they can fill out a form. If you can show that you've paid your mortgage payments, if you've paid other things on time, but maybe you had a repossession or maybe you had a divorce, we have so many more options to get you into a home if we can show that you have recovered from those. If you're currently missing payments and you just have no money, then that's a different conversation. You can't be actively missing payments, but if you've overcome whatever caused your credit to be on the lower side, there are so many more chances to buy a home right now. The biggest things that we see, especially when people start saying they want to buy a home, everyone out of the in their family, coworkers, people just that you come around in life, they start telling you, oh my gosh, you got to do this. It's going to help you out so much. Or I saw this guy on a reel who told me to dispute everything on my credit to improve my credit score. So credit scores that we use are closest to the FICO model. Myfico.com, FICO, is going to be the closest to what an actual credit score is. The one you get from your credit company, credit card company, or from Credit Karma, those are not credit scores. Those are kind of some made up numbers. They want you to maybe click on one of the links from the advertisers that they offer and maybe apply for something, and then they get a kickback. So do not dispute items on your credit. That is the number one thing that we see. You see it on a reel, hey, you can improve your credit score. It does improve your credit score because it hides the things that puts a mask on them, which is fine if you're buying a car or getting a new credit card. But when you're purchasing a home, a dispute is the worst thing that you can do because it puts a fake credit score, and then we have to remove the dispute, which tanks your credit score even more. Not missing any payments within 12 months is huge. Honestly, once you've missed a payment and then 12 months has passed, it stops hurting as much. And then every month after that, it just starts to improve. Not closing any accounts. We see a lot of people where they're like, hey, I have 5 payments left on my car loan. I'm going to pay it off. I did amazing. And I go, oh no, because a credit card is open all the time. A car loan, once you pay it off, that history of you paying on time is gone. So if we are really short on having a good full credit profile from you, sometimes that 5 more months of a car payment actually helps us. And even though we have debt ratios, a lot of the times we can either pay it at closing or we can exclude it. We can remove it from your debt because there's only a couple months payments left. But don't close anything, even if it seems like a slam dunk. When you close accounts, we miss all of that past positive credit history. And then this one surprises people every day. Do not make payments on collections or charge-offs. When you're looking at your credit score and you go, hey, I've got this $1,000 charge-off from a Chase credit card 8 years ago. Do not make a payment on it because it will change the DLA, the date of last active or date last activity, whatever it'll say on your credit thing. Then it will hurt your credit again as if it just happened. So if you have something and you go, I'm scared, I'm worried, we have opportunities. Just number one, we can start off looking at annualcreditreport.com. That is a place that is done by the federal government for your credit bureaus. You get one copy per 12 months from each credit bureau. You can save it as a PDF. We can look through it. We can do a soft credit pull. They're like $30 versus doing a full credit pull. And we can really start to dive in and say, okay, is there anything that we need to be worried about before, or that we need to address before we kind of really start applying? The biggest things right now are the down payment. Obviously, life has just gotten more expensive. We have people who say, I have money for a down payment. I'm not sure if I want to use it. And then there's people who are like, I don't have that much money for a down payment. So we're going to kind of compare today FHA loans with the minimum 3.5% down. FHA, a lot of people think that stands for first-time home buyers for whatever reason, but it just means Federal Housing Administration. Did I just say that right? Federal Housing Administration. Yeah, right. Oh my gosh. I've said that for 19 years and now I'm second guessing myself. Conventional loans, you'll also see sometimes the news, like a CNN or a Fox News will say Fannie Mae did something or Freddie Mac did something. Those are just investors who purchase conventional loans. The government also has its hand in them. FHA loans are going to be great for everyone. If you have really poor credit or really great credit, it doesn't care. Your rates are pretty much the same, and your monthly mortgage insurance for not putting 20% down or for doing an FHA loan in general is the exact same for every single person. If you are looking at a conventional loan is going to be, here we go. Welcome, August. I will, if you have any questions, please let me know. And we'll go over anything at the end as well. So conventional loans are going to be great for our high credit, higher income buyers because conventional loans do penalize you. So at a 760 or 780 credit score, that's the top. But for every 20 points below, you get penalized for conventional, whereas FHA really doesn't care. FHA is going to treat you the same at a 580 credit score and a 780 credit score. Sometimes people will say you need to get a conventional that's better, but a lot of the times conventional payments are higher unless you have excellent credit score. And then of course the VA benefit with 0 down is amazing for our military members. There are some struggles with getting some of those offers accepted because there are opinions in the real estate world about VA loans. And so having someone on your side, having a great real estate agent and having a great lender who knows the programs to fight to get your offers accepted is really the biggest key with VA. A lot of people don't realize that you can still do 401k loans. So if you've been putting money into a 401k or a 403b at your company, and they allow you to withdraw a loan that will be something that you're paying yourself back on. You're not paying any taxes as long as you stay with the company. That ends up being one of the most overlooked ways. People go, oh, I've had a 401k loan for a while. I thought I could only take 10,000 out of it. A lot of companies will let you take 30 to 50% of the balance of your 401k as a loan. They kind of make up whatever rules they want to make up. Savings and investments, any savings, including like crypto investments, as long as we can document it, we've got to get the statements and everything, we can use those. If you are purchasing a home after already owning another home and you say, I don't want to sell that other house, the rate's really great, we can look at doing a line of credit on that house. And we can kind of go over all the options. And then down payment assistance is obviously, it's amazing. It's not free money, and it does often have to be repaid, but it can be a huge way to get into a home. Last, I'm going to make a little note. If you do have really generous family members that are giving you a gift, please consult with a loan officer. I'm happy to go over all the things. You're not going to take that money from your family. You're not going to get a deposit from them because it makes the amount of paperwork that you need from them exorbitant. It's just excessive and they get upset. Number two, we are going to have the conversations up front about any gift money. So they do have to sign a letter that it is a gift and does not have to be repaid. And 99 times out of 100, the concern is tax liabilities or triggering anything with taxes. But unless you're getting gifted millions of dollars, you're not anywhere near the maximum. So we can get them speaking with their, family tax people, or we can refer a tax person to really explain how that works, because it's nothing in the end. So down payment assistance is really overlooked for a lot of people. So California, Texas, and Florida are where we see a lot of buyers right now, but there's down payment assistance opportunities in basically 49 of the 50 states, except for New York. There might be some in New York, but I don't really know those. The California down payment assistance, a lot of people are going to go towards the CalHFA ones, the California Housing Finance Agency. There's a couple of programs. They offer FHA and conventional, and we can kind of look at both options. The FHA one is really great. It does offer you 3.5% towards your down payment, which is the exact full down payment for an FHA loan. They have it called the My Home program. And then they also have this called their Cal Home plus ZIP program. The ZIP is a zero interest program. So they'll even give you 3% as well towards your closing cost program fees. They have fees. There's going to be closing costs, which we'll kind of go over, upfront property taxes, home insurance, etc. And then on top of that, you can negotiate when you're doing like an FHA loan, you can negotiate up to 6% in seller credits. Now, over the last year or so, there does have to be negotiations up front about who's paying the buyer's agent also. That was not a conversation we had 3 years ago. So some clients will find that the listing says, yes, we will pay your buyer's agent. So that is no longer a negotiation. Your buyer's agent's getting paid. That's off the table. You don't have to worry about it. And now at this point, you're just negotiating on the price. The reason this matters is because a lot of people will say, I am looking at just a $500,000 home, and I really want to give a lower payment, a lower offer at say $480,000. And I go, okay, well, why? And they go, because that's going to get me the best deal. And they go, well, possibly. And we'll kind of look at how lowering your down payment, lowering your purchase price affects your monthly payment, but it's not what you think. So oftentimes keeping that purchase price a little bit more elevated, closer to the seller's asking price, maybe, a little bit negotiated off with a significant down payment, significant seller credit, that is going to save you a lot more money in the long run. So we'll kind of look at all the different ways you can use those seller credits in just a minute. In Florida, so eHousing Plus is who does the California program. The same program is done in Florida. It's from eHousing Plus. It's called the FHF program. They will offer you between $12,500 all the way up to 5% down payment assistance. Depends on the loan type, depends on a couple things. But the other thing to consider with FHA and conventional, we'll kind of go over it, is that FHA loans are going to allow you to get a 6% seller credit. Conventional loans start off at only letting you get a 3% seller credit. So when we kind of look at all the things, you go, why would anyone do conventional? It's really great if you have your own money, if you plan to be in a home a long time. We'll kind of look at all that as well. And then the other thing that has really boomed in the last 18 to 24 months is private down payment assistance. There was for a long time only California, Florida, Texas, Arizona, whatever it was, down payment assistance programs. And now a lot of the actual individual mortgage companies have come in and said, okay, what will the federal government allow us to do in terms of giving buyers down payment assistance? So there can be down payment assistance, even if you're not a first-time home buyer, even if you have a very high income, similar things, 3.5% to 5% towards your down payment. The biggest thing, and I think I have it on one of the slides over here. Here we go. So the biggest things with government programs, you can see up in this corner here, this top is CalHFA, it's the California Down Payment Assistance. The bottom is Florida, and that's as of today. So the programs that are listed are going to offer you one interest rate. Like when you are looking at purchasing a home, it's always like, this is the rate, but there are 20 interest rates available. That's not the case when it comes to down payment assistance from a state or county. You are going to have one interest rate, depending on how much assistance you choose from them, basically. So what that means is that if you get a really large seller credit, sometimes we go, hey, it may not make sense to take this program. We really can't use all that money because we cannot buy down, we cannot pay for a lower interest rate when it comes to state programs. But there are private programs, there are private mortgage companies that basically they're lenders, and they also offer programs. I have a list of like 14. I was going through it for a client the other day, just really creating a spreadsheet for myself because there were so many nuances. And it's not one of those things where you go, what's the best? I don't know. We've got a lot to dig into. Where's the money coming from? Is it from family gifts? How much is coming from your own funds? What's our down payment percentage? What is our credit score? What is our debt percentage? Some of the private programs can even be forgivable. If something is forgivable, your interest rate is going to be even a little bit higher because eventually you're no longer going to owe that money. We have to compare a lot of things. But if you do negotiate really well and get a 6% seller credit, which on a $500,000 home is $30,000, we don't just say, boom, here is the deal for you. Here is the loan that makes sense for you. We really have to take a step back and go, how do we utilize this money in the way that's going to lower your payment up front, lower it for the life of the loan if possible, lower your out of pocket, and be basically the best case scenario. Some of the down payment assistance programs will have monthly payments. Some of them will not have monthly payments. Oftentimes it's like divided over 20 or 30 years. It's like $50 here or there, or it'll be a deferred where you don't make the monthly payments. Some programs will have income limits. The state of California one was like a $236,000 income limit on some of the programs. Some of the Florida ones are around 123,000. And then there are programs with no income limits, especially on like the private down payment assistance options. So when we start looking at numbers, I always warn people, you are going to be shocked, especially if you've been renting for a while. So before we even look at numbers, I usually tell people, I go, please go on Zillow Rentals, go on Rentometer, which is like rentometer.com, and plug in your address and just look at things. You're thinking about purchasing a home. You've been in your rental for 5 or 6 months, 5 or 6 years, 10 years, 12 years, whatever it may be. Your landlord bought it super cheap, their payment's low. They've been just so happy to have good renters that they have not been increasing your rent. Your rent is $1,450. Your rent is $1,650, $1,850, whatever it is. That is not what the rent would be if your landlord said you have 60 days to leave and you went to go rent a new home. A lot of people are so shocked. So I kind of tell people, okay, start there. If you were forced to leave your house within the next 30 to 60 days and wanted a comparable house in a comparable neighborhood, what would your monthly rent be? You're paying $1,650 right now. It's probably $2,400, $2,350, whatever it is. That's kind of the number that you want to compare it to, because your landlord, at the end of the day, they could choose to kick you out at any point in time. And that's what we have to compare things to. So Zillow Rentals and Rentometer are just two of my favorite to kind of start at. There's a lot of numbers on here. I'm just going to kind of point out a few. A lot of the times people will say, I want a conventional loan. I only have to do 3% down on a conventional loan and I have to do 3.5% down on an FHA loan, of course I'm going to choose a conventional loan. And I go, well, maybe. And then they go, well, what else? Well, the upfront mortgage insurance, that is something, it's called UFMIP. That is something that FHA does require because they give loans to basically anyone who can qualify. They don't penalize a 580 versus 780 credit score buyer. Every single person will add 1.75% of how much they're borrowing to their loan amount. People always go, oh my gosh, of course I want a conventional loan. I'm going to add on a $450,000 house, I'm going to add almost $8,000 to my loan amount. On conventional, I would add zero. Like, tell me that you're kidding. Why would I not look at a conventional loan? Well, this is where we kind of get into unique areas. So a couple things with conventional loans. The conventional loan interest rate will be a little bit higher than the FHA loan. Just it's always been that way. And if you have poor credit score, it's much higher. The other thing is that your mortgage insurance, because you're a higher risk for not putting 20% down, your mortgage insurance is based off of how much you put down and your credit score. So if you have excellent credit, you could be looking at like a third, 0.3% or 0.5% of the purchase price of the loan amount, really, for your mortgage insurance. But if you have really poor credit, if you're at that 620 credit score, kind of like the lower end, you could be looking at almost $400 a month. So at the end of the day, we have to really look at what makes the most sense. The monthly payment on that same FHA loan at $450,000 is around $33.61. The conventional is $35.25 to $37.89. So there's a couple things. The conventional loan would make sense for someone who's a high net worth person or a high income person, where they go, you know what? I know that I can pay my loan down really fast and I'm going to get rid of this mortgage insurance. And I'm going to refinance in a year or two. I don't want that extra 8,000 added in. Like, there are some people that we make it make sense for, or if you have a high credit score already, it can make sense on its own. But for most people, they start with an FHA loan just because it is the least barriers to entry. It is just the easiest to get into. The other biggest thing with FHA, you can see at the bottom, a little bit cut off. So at the very bottom here, the FHA loan is going to allow it to take up to 6% of seller credits, which is $27,000, versus the conventional loan, if we're not putting at least 10% down, is only going to let us do 3%, which is $13,500. So you leave a lot of money on the table unless you have all that money and you don't need it, where you can't take it from the seller if you are really not looking at all of your options. So a couple things when we're looking at a seller credit, when we look at $27,000 in seller credit, that's a lot of seller credit. Just touch the microphone. Hopefully it didn't be too crazy. What are ways that we can use that? So closing costs they're going to be between like $7,500 and probably about $10,500. That's going to be like 1 year up front of your house insurance. If you have any HOA dues, like you're buying a condo, you're buying in a neighborhood that has a gate or anything like that, Anatolia, that's going to have homeowners association dues. You can pay a couple months up front to start. You can even pay up to 12 months up front with seller credit money to help you get that down. Your property taxes, we kind of start at 1.25% of the purchase price. That's legally where we have to start. But depending on the area that you're purchasing in, you may find that there's a school bond or a library bond. They just redid some schools, they just redid some libraries, they just redid some like parks, and there might be like $4,000 left on the property tax bill that's adding 50 or $100 a month to your payment. We can use that money. We can call the county and say, hey, how much money is left on this bond? And they give us an amount and we go, we're going to pay that off because it's going to save you this amount of money every month. The other thing that we can do, this 1.75%, that is an upfront mortgage insurance. Naturally, it's rolled into the loan, and most people do roll it into the loan. But they were doing an FHA loan because you just had a bankruptcy like 2 years ago, or you had a foreclosure 3 years ago, and you go, okay, I really want to get out of this FHA loan as soon as possible. I don't want the $7,875, whatever amount it is, added into my loan. The seller amount of money that can pay for that. On a conventional loan, on a regular mortgage, the seller credit can pay for that monthly mortgage insurance in full. Now, if you have very low credit score, that could be really, really expensive. If you have a good credit score, though, that could be, $6,000 up front to save you $130 a month. And again, these are a million numbers, but if you've spoken to a lender and they've not mentioned anything about these, about possible ways to use down payment assistance, possible ways for you to use seller credits, it's just because it's easy to just say, here's your loan. Like, here's your menu. You got 3 things on there, check out and be done with it. It's more work to do all of the pros and cons. It may confuse you a little bit, and then they've got to go back and say, hey, it's a great thing to have options, but what do we think? And most people don't want to do that. They don't want to confuse you. They want to keep you as happy and neutral as possible and just get you to the closing line, which is great. And 2 years ago, if you had said, Ashley, what are my options? I'd be like, not much, because down payment assistance was not as readily available for lower credit scores. And also, home prices were selling at their asking price or above in a lot of areas. We're finally seeing it where those seller credits are actually making sense, and you can use that money to benefit you. So if you go, why didn't anyone tell me this 2 years ago? It really wasn't a thing 2 years ago. But if you've spoken to a lender in the last 30, 60, 90 days, they haven't had similar conversations, then that's another issue. So what are all the ways to get your monthly payment down? I just kind of mentioned them. So the Mellow Rue bond, CDD, special assessment, whatever it's called, school tax, whatever it's called, we can call the county and say, how much is due on, it's a line item. It'll be like CDAF 37. How much is left on this? And they might go 30,000. I go, okay, I can't pay that off. And I go to the next one. How much is due on this one? They go 1,200. I'm like, I can pay that off and I can save them, $50 a month or whatever it is. The mortgage insurance can be paid in full, as I was mentioning. The upfront mortgage insurance can be paid in full. VA loans, VA is going to have a funding fee. They're not going to have mortgage insurance. They don't charge you monthly, but they do have a funding fee unless you're a disabled veteran. And that can be like a little over 2%, 2.15 to 3.3%. Most of the time that's rolled into the loan. If you have enough seller credits and it makes sense, you could use it to pay that off. It just really comes down to what other ways can we use that money. On VA loans, seller credits can even be used to pay off debt. So oftentimes when we look at the monthly payments and how we can get things down, paying off a debt is kind of the best bet. The other thing is the interest rate buy down. So over the last couple of years, you've probably heard of buy downs. Those are what we call temporary buy downs. Sometimes you would see a listing and people just expect everyone to know what this is. And even as a lender, I've got to go through and be like, I got to calculate what the actual numbers are on this. It would say like 2-1 buy down or 3-2-1 buy down. And you would have a lower interest rate for the first year at 3% lower, the second year at 2% lower, 1 year at 1% lower, and then the interest rate would go up. The reason those were sold is because we expected that interest rates would be lower at this time, that rates would probably come down a little bit. And they have from their height, but the permanent buy downs from seller credits, if you're getting $5, $10, $15, $20,000 in credits from your seller, it may make sense to buy down the interest rate. For example, on a $450,000 loan at say 6.5%, that's a $2,844 payment that's only the principal and interest is only paying back the loan, not including the taxes and insurance, versus a $2,626 payment. So $218 monthly savings, and it could cost you potentially $14,000 to buy that. But if the sellers are giving you that money and you go, Ashley, I have this extra $14,000, what is the best option for me? Now, maybe it's this, or maybe you say, I'm not going to be there very long. What are my other options? Or I'm going to give it to my son after a few years. What are my options? If you are not going to stay in that loan for more than 3 or 4 or 5 years, then we may not want to look at a buy down. We may not want to waste that $14,000 on that. We may want to do it something like paying some of the property taxes off or paying some 2 years of homeowners insurance if they'll allow us. It just depends on the companies. A couple years of home warranties. There are other things that we can do, and it's not just this is your best. because not everyone's going to stay in the same home or make the same choices for the same amount of time. So here's kind of that same loan scenario. FHA at that $3,300 payment, conventional at $3,500 or so. And again, FHA, the biggest thing is the monthly mortgage insurance. It goes on forever. So when we had people, when the rates were a little bit lower and people were staying in their loan for a long time, they'd go, man, I have to pay this $199 forever. They go, maybe I do want to take the higher rate. And once I've paid down 22% of my loan balance, I can get rid of it. But with the rates being the way they are, and we know that they've kind of been here for a while, and we hope that maybe they'll come down, it's not the same conversation anymore. We're not planning to be in that same mortgage for maybe 10 years. This is the biggest conversation. So once we look at payment shock and we really look at what does the monthly payment look like, we also look at the monthly payment and how it changes based on how much you put down or how much you lower the purchase price. So pretty much everyone has purchased a car, and whether they got approved through their bank, through their credit union, or at a dealer, they give you like those little pieces of paper, and the payment changes so much. Literally, it's like whiplash how much the payment changes. For every like $10,000, you purchase a different price on a car. So $40,000 car versus a $50,000 car at seriously like an 8% interest, not even low interest. At an 8% interest, 40,000 versus 50,000 on a car is $200 a month payment difference. So that's going to be like where you go, oh my gosh, $800 is insane, but I could do 600, whatever it is, right? But that's because it's over 5 years, maybe 6 or 7 years, depending on what you're looking at. On a home loan, because it's amortized, it's divided over 30 years. Literally, there's a calculator spreadsheet we can look at. It's 360 lines because there's 12 months times 30 years. And it will tell you how much is paid towards principal and interest every month. And it starts off a very small amount going to pay down the loan. So when you lower your purchase price or lower your loan amount by $10,000, it changes the payment $63 per month. So that's why when we say, a lot of times people go, oh, salespeople say that I shouldn't negotiate the purchase price. If the home is 500, of course I should offer 480. And I go, maybe to save 126 bucks a month or so, and to save a little bit less on your down payment, 600 bucks on your down payment. But what if we were to give them their full asking price or close to full asking price and ask them for a $20,000 credit? That $20,000 credit could potentially lower our monthly payment $218, plus we would still have money left over for closing costs. Like it could keep our out of pocket as close to just our down payment as possible. Like there's conversations we have to have. And I know that it feels like there's bait and switch and that there's a lot to be like concerned about. And I get it. There are a lot of people who seem sharky. The numbers really are just math though. It's just a matter of looking at them kind of in different ways. So the debt to income ratio, it really matters. And car payments are the biggest. We've never seen car payments as high as they have been lately. When the Teslas first came out and we saw those $1,400 Tesla payments, I was like, that's insane. But now, I mean, a normal mom SUV costs 80 grand half the time, right? So if you were to say, Ashley, I have a $500 car payment, I got a great deal on the car, it's about the equivalent of buying an $80,000 house, because for every $10,000 you're borrowing, that's $63 a month. So just to kind of put that into perspective, and it's not something you need to like know, but you just need to think about that. Hey, I really want to buy a car, but I don't need a car. If I buy the car before I buy the house, I get a much worse house. If I buy the house and then I buy the car, I get a nicer house, and then I can figure out what I qualify for and what I still want to buy as far as a car. So when you buy the house first, you still have options with the car. When you buy the car first, you kick all of your options to the curb, unless you magically have a family who wants to co-sign with you, which we usually recommend against because it never works out for them. Or if you have like huge inheritance, gifts from family, etc., those car payments really just can crush you. When you are ready to apply, we are going to tell a story about 24 months of everything about you. 24 months of where you've lived, where you've worked, your human resources, like your boss contact info, the most 30 days, most recent pay stubs, W-2s. If you have any extra income, bonuses or tips or overtime or your variable pay, we'll look at maybe looking at the last 2 pay stubs for the last 2 years. That final pay stub really tells us a lot. When we ask for your bank statements and your crypto statements and everything, we need all the pages, even if they're left blank. And then the biggest things, divorce. I feel like we had for a while, there was just divorce had slowed a little bit and now it's booming after the pandemic. So if you've gone through divorce and you have child support and alimony that you're paying, we have to document that amount. If you have child support and alimony that you're receiving, we do not have to use that. But if you want to use it, or if it helps you, we do have to show that you're receiving it, that it's being paid regularly, and there has to be at least 3 years left of receipt. So if your child aging out of it, we may not be able to use it. The escrow company it always comes up, escrow, 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 escrow. I follow a lot of realtors online and I just go, do you guys realize that most people have no clue what you're talking about? We open escrow, we close escrow, we did this with escrow. So there's 2 escrow meanings when you're purchasing a home, and the escrow company is going to be the neutral third party. The escrow account is the savings account for property taxes and insurance. We'll kind of go over all that, but the escrow is like thrown out there as if you should know exactly what it means, and you don't always. Once you do get into contract on a home, once we go through the full pre-approval process, we see what you qualify for, things do move really quickly. So a lot of times people go, I'm going to make an offer and then I'll think about it. And that's not the way it works. So we really do need to work together to see what you qualify for. And I'll kind of go over that in the next few slides. The appraisal to get the value of the home and your deposit on the home, which is like 1% of the home or more, is due within 1 to 3 days, calendar days of getting your offer accepted. You're going to order inspections probably. You don't have to, but most people do. Home, pest, roof, sewer, pool, anything you want to. And then at closing, we'll have the rest of the money due. So when we're going over, once you get pre-approved, we're actually going to be looking at each specific house and we're going to say, what are the property taxes on this home? What is the insurance on this type of a home? How much is it's in the city of Sacramento or the city of wherever, and they have their extra transfer tax. They have an extra fee on top of it. How much is that? And how is that going to impact us? So that's going to be your total cash to close out of pocket. The escrow company, that middleman, that neutral third party, they're the ones who help us figure out exactly what is owed, how much the seller owes on their house, how much your deposits are, how much your property taxes are, everything. We do it together. I'm going to kind of just go through this real quickly, but your loan officer, your processor, that's going to be on the loan side. Your realtor, they're going to have a transaction coordinator helping them. And then you're going to have the escrow officer in the middle between you and the seller. And then if you have an insurance agent you already use or you need a referral for one, that's going to determine how much your monthly insurance is, because that's a year of insurance divided by 12 months. You want to do as many inspections as you think is necessary and that you can afford, because you want as few surprises to come up. And then if you do purchase a home that has an HOA, homeowners association, we really do rely on that company to give us things. Not every HOA company is amazing. So we will ask them for paperwork, for documents, for budgets, etc. And we hope that they're timely and quick. But if they're not, it kind of gives us an indication of, you know, what that community is like. So really, how much you can truly afford, this is where you have to think about your numbers. And we really want you to look at your budget. And most lenders will never even say this to you. Most lenders will say that we will take your before tax income and you can use 45, 50, 55% of it to debt, towards debts. And that's great, because lenders are only looking at what's on the credit report. They're looking at student loans. Even if there's no monthly payment, we have to calculate one. IRS repayment plans, alimony and child support, plus anything on your credit report, like minimum payments on credit cards, car loans. At the end of the day, we want you to be home proud, not house poor. So here's a real kind of starting example for someone with like an $8,000 monthly gross income. If you live in an area with state income taxes, for example, you're probably looking at like $6,000 after tax. this is kind of a note about how we calculate the payment here. So if you said, I have $6,000 of after-tax money and I've got daycare. Daycare is not something that we use to care about unless you're a VA, veteran. But on regular loans, we don't look at daycare. But you have to think about it because you have to make those payments, preschool, daycare, whatever it is. Daycare, $1,500. Even if you don't have a kid right now, you're thinking about having a kid in the next year or two, do we want to max out your house payment? And then you all of a sudden have this huge bill. Groceries, lifestyle, eating out, estimating say $750, utilities, insurance, subscriptions, etc., $800. Just kind of like some numbers thrown out there to kind of get you just some overall bills. 6,000 minus 1,500, 750, and 800, that brings us down to 2,950 a month. And if you said, if I had 2,950 a month, where does that leave me? A lot of times people will go to these online mortgage calculators where they only calculate the monthly payment on the loan, the principal and interest, which is $2,950. That gets you like a $485,000 purchase price. But that doesn't include your property taxes or your homeowner's insurance. So if you kind of back away from that, I said, let's look at a $400,000 loan. If we estimated, say, 6.125%, we estimated property taxes are 1.25. They could be higher, they could be lower. If there's new schools, new parks, new infrastructure, they're going to be higher. Homeowners insurance, we estimate $80 a month. If you've got flood insurance or if you're in a high fire zone, that could be more. If we did like a FHA mortgage insurance for say like $174 a month, then we'd be looking around $3,102 a month, including everything, not including a homeowners association due. We're pretty close to that $2,950. So maybe a lender would say, yeah, you qualify for, I don't even know, $8,000. You qualify for $5,500 a month. No, $5,000 a month. I can't do the math right now. $8,000 times 56. $4,480 a month. Do you want a $4,480 mortgage payment? Now, if you say, Ashley, I make this amount, but my girlfriend, my spouse, so-and-so in the house makes more, or hey, I also have veteran disability benefits that are not taxed, whatever it is, if you have other sources of income coming into the house, it's a different conversation. Like we can look at maxing things out versus if this is all your income, we want to take into consideration what your true comfort zone is. So there are a couple of funky things we have in California and Texas specifically. So California, Texas, and Florida are where we see a lot of customers buying. And then if you're leaving California and going to like an Arizona or Idaho or Nevada or Washington, this also applies. All of those states are what we call community property states. You've probably heard that mentioned when it comes to divorce, but what that means when it comes to a home loan, especially if you're getting an FHA loan, is that your spouse's credit, their debts, their negative items on their credit, they can hurt you. Even if they're not on the loan, we have to look at those. So that could be one reason why we say we're looking at the conventional, the other mortgage type, even though it's a little bit more expensive because you won't qualify based on your spouse's debt because you're in a community property state. That catches a lot of people off guard. And when people have talked to lenders who don't know community property, California, Texas, etc., they get into hot water. They make an offer on a home. They think, hey, this is great. My income's great. My husband's income's not great. I left him off the loan. Oh man, it's weeks into escrow and they go, it's a community property state. We actually have to count him, his debts. If you're ever paid less than 40.00 hours per week, we have to look at an average. So getting those last 2 pay stubs for the last 2 years is huge. If you owe money to the IRS, a lot of people will say, I want to get the IRS paid off before I buy a house. And you can, but if you have a repayment plan agreement with them, even if it's like $50 a month, as long as you've made a couple payments, depending on the loan type, you may not have to make any or maybe just one, we can qualify you in a lot of cases, unless you have like judgments against you from the IRS where they're coming after you. If you have lower credit scores, but you can prove that you've overcome the issues that came with those lower credit scores, you're paying your rent on time, you're paying your bills on time, maybe it was just like a one-time, hey, there was sickness in my family, there was a death in my family, there was a divorce, etc. We oftentimes can look at getting you approved for more loan options than you think. If you have loans close to being paid in full, please don't pay them off, like I was mentioning earlier. The biggest thing that surprises people is that after you purchase a home, everything about that home purchase, basically except for the interest rate in most cases, is public record. So people are going to start to say, oh my gosh, hey Joe, Ashley did a great job on your loan. Let's look at doing this. Or here's this paperwork you forgot to sign. And then in tiny little fonts at the bottom, be like, we are not associated with your state. We are not associated with the federal government. And they're like, hey, just pay these $85 you owe to register for the deed. Pay this to look at refinancing your loan, even though it doesn't make sense. Those are all things that are public record. So you want to stay in touch with your loan officer after closing. And at the end of the day, the best loan is the one that's best for you. I can't tell you how many times we talk to people about getting a loan. And if we know that it's not like your cookie cutter loan, I will specify over and over again. Like if you mention this loan to 9 out of 10 people, they're going to tell you you're getting ripped off. And here is why this is important to you. Here is why you're taking a higher interest rate, because you didn't get a seller credit, because you don't have the down payment, extra down payment, and you have no other options. But we're hoping that the values continue to go up and we can refinance in the future. If you talk to, your cousin's brother's best friend who works at your neighborhood store or whatever, they're going to be like, that's insane. You could get this and this and this. And it's just not the case for everyone. So if you have questions, if you know that you're doing something that's unique, make sure that you understand it, so that you can stand up for it. And you don't always have to talk about your loan scenarios with other people, especially if you know that it's specific to you because of maybe a financial hardship or something in your life. So if you have questions, if you're ready to take the next step as far as doing an application, or just doing a consultation for like your specific scenario, you can scan that QR code, ashleywillardmortgage.com. I'll send an email out when the replay is available for this as well. But if you say, hey, I really want to see what this type of a home looks like, what this kind of a payment looks like with my credit score, with my income, etc., we can look at some scenarios as well. The nice thing about this is that we're seeing more and more homes that are selling with seller concessions, with the credits from the seller to the buyer than we really have in, I don't know, probably since 2013. So you have so many options. At the end of the day, though, it can be overwhelming to have so many options. So if you have questions, if you want to put them in the chat, you're welcome to. I'm going to end the recording here in just a moment so I can get everything saved and get it uploaded. And then seriously, if you have any questions at all, please reach out. Numbers are my favorite thing ever. I love getting people into homes. If you've spoken with realtors and you feel like I have to use them because they're a friend of the family, they're in my neighborhood, maybe you want to, but right now we need such strong negotiation skills that oftentimes we'll go, well, can we just look at, maybe what area they're familiar with? And maybe they are a great realtor, but they're a great realtor in one city or one county, and it's not the one that you're looking at. And we go, okay, well, this person has sold 26 houses in the area that you're looking at. Maybe we talk to them and see what their scenario is, what they think the process is, what they think, is likely in this area. Because of the new terms with buyer's agents and signing up front and agreeing to pay your buyer's agent if the seller is not going to pay them, it's not quite as easy to leave an agent, and we never want you to leave them. We want you to get set up with the best possible agent for you. And so to ask those questions up front is huge. So, all right. Thank you so much for everyone who stayed on until the end. I'm going to get this set up